You know, I was walking through my living room this morning, tripping over a slightly uneven floorboard, staring at a hairline crack in the plaster near the ceiling, and I had this sudden weird realization.
Oh, yeah.
We spend so much of our lives thinking about our homes purely as shelter. It's where we sleep, it's where we make toast, it's where we argue over whose turn it is to do the
The
dishes.
important stuff.
The really important stuff. But we rarely stop to think about the fact that we are physically living inside a financial instrument.
It is a bit like living inside a high-yield savings account that you also have to vacuum and paint every few years.
Right. A high maintenance savings account that occasionally leaks water. But that really is the core of what we're exploring today.
Hmm.
For millions of people, the house isn't just a home, it is the hidden piggy bank.
For sure. For the vast majority of the middle class,
Yeah.
it is the single largest asset on their personal balance sheet. It dwarfs everything else.
But unlike a ceramic piggy bank, you can't just smash it open on the kitchen counter when you need cash for a vacation or a medical bill.
Well, you could try, but the repair costs would essentially negate the withdrawal, and your neighbors would probably call the police.
Exactly. So the question becomes, how do you get the value out without selling the thing and moving into a tent? And that is our mission today. We're doing a deep dive into the world of the home equity loan.
And I think it's important to say right up front, if you're listening and thinking, oh, I know about these, maybe stick around.
Why is that?
Because the entire landscape of borrowing against your home has completely shifted beneath our feet. It's a whole different ballgame than it was even a decade ago.
It really is. I was surprised looking through the research. If you bought a house 10 or 15 years ago and you think you know the rules of this game, you might be in for a rude awakening.
The tax laws have changed, the structures have evolved, and the risks. Well, the risks are always there, but they look very different in today's economic climate.
I've got a massive stack of source material here covering everything from ACLSEs to federal tax regulations. Our goal is to move past the jargon. We're going to explain LINs and LTVs so they actually mean something to you, not just acronyms on a piece of paper.
We want to get into the nuts and bolts,
We want to understand the reality of putting your shelter on the line for cash.
and that is the key distinction to start with. We're talking about liquidity, yes, getting access to spendable money, but we are also talking about collateral.
That's the word.
This isn't a credit card where the worst-case scenario is a bad credit score and some angry letters. This is your house. The stakes are literally the roof over your head.
That puts a bit of a chill in the air, doesn't it? But it's the necessary context. Okay, let's unpack this. Let's start with the absolute basics. Section 1, the fundamental mechanics.
Let's do it.
When we say home equity loan, what are we actually defining? What is this beast?
At its absolute core, it is a secured loan. You, the borrower, are using the accumulated equity in your property as the collateral to guarantee the debt.
Okay, equity. Let's break that down first. That's just the part of the house you actually own, right?
Right.
The value minus what you still owe on the mortgage.
Precisely. If your house is worth $400,000 and you owe $250,000 on your mortgage, you have $150,000 in equity. That's your piggy bank.
And collateral. It's such a heavy word. It sounds like something from a spy movie.
It's the ultimate leverage. You are telling the bank, I promise to pay you back, and I am so confident that I will pay you back that if I don't, you can take my house.
Wow, when you put it like that.
That security is why the interest rates are generally lower than an unsecured personal loan or credit card, but it's also why the process is so much more invasive. They want to know everything.
Right, because the bank isn't just looking at you and your credit score. They are looking at the asset. They need to know what the house is actually worth.
Exactly.
And from the research, it seems the bank doesn't just take your word for it. You can't just print out his estimate.
Lots. No, definitely not. You can't just say, well, Zillow says my house is worth $1 million and my neighbor sold his for a fortune, so cut me a check. The bank relies on a gatekeeper, the appraiser.
The person with the clipboard who decides your financial fate.
Essentially, yes. The lending institution sends an independent third-party appraiser to determine the fair market value of your home.
And what are they looking for? Are they, like, checking for dust bunnies?
Not exactly. They're looking at the big picture. The condition of the roof, the age of the HVAC system, the square footage, the number of bedrooms and bathrooms.
Hit the hard facts.
And, crucially, they look at recent sales of similar houses in your immediate area. They call them comps or comparables.
So if 3 houses like mine on my street sold for around $400,000 in the last 6 months.
Then your appraisal is probably going to land right in that ballpark. They're trying to establish what a willing buyer would pay for your house today. That number, the appraisal value, is the hard ceiling.
It doesn't matter what I think the house is worth or how much sentimental value it has because my kid grew up there.
None of that matters to the bank. The loan limit is strictly determined by that cold, hard number on the appraiser's report.
Okay, so let's say the appraiser comes in, looks at your new backsplash, nods approvingly, and gives you a number you like. You move forward. Now we run into this legal term that I see everywhere in the fine print. The lien, L-I-E-N. It sounds almost predatory, like a lion waiting in the tall grass. What is a lien?
It is a very serious legal concept. When you close on a home equity loan, the lender places a lien against your property. Think of it as a legal claim or a neon sticky note superglued to your property deed at the county recorder's office.
Public record.
It's a public record that says, this property has a debt attached to it. The owner cannot sell this house or transfer the title cleanly without paying us, the lien holder, first.
So it's basically a flag that tells the whole world, hey, the bank has a piece of this property.
That's exactly what it is. It secures their interest.
And that lien then has a mathematical consequence, right? It's not just paperwork floating in the ether.
Correct. It is a direct subtraction from your ownership. Your equity is simply the value of the home minus what you owe. The moment that lien's been recorded and the money hits your account, your equity drops.
So if I had $150,000 in equity and I take out a $50,000 loan,
your equity is now $100,000. You've effectively transferred that ownership stake to the bank in exchange for cash. You own less of your home than you did 5 minutes ago.
which brings us to the term second mortgage. I've heard people use home equity loan and second mortgage interchangeably. Is that accurate, or is there a nuance I'm missing?
No, it's very accurate.
Yeah.
They are called second mortgages because of their position in the hierarchy of debt. It's all about who gets paid first if things go wrong.
Like a dinner line.
It's exactly like a dinner line. If you go bankrupt, or if the house is sold to pay off debts, the first mortgage, usually the big loan you used to buy the house initially, eats first. They are first in line and get paid back in full.
And the home equity loan.
The home equity loan sits in the second position. They get whatever's left over. The scraps, if you will.
Which explains why the interest rates on these are usually a little higher than a primary mortgage. The bank in the second position is taking on more risk.
Way more risk.
If the house sells for less than expected and the money runs out before they get paid, they're just out of luck.
They're out of luck. They take the loss, and because they are taking that risk, they are incredibly picky about who they invite to the party. This isn't a loan for everyone.
No, the sources are very clear on this. It's not like applying for a department store credit card.
Not at all. Most home equity products require good to excellent credit history. We're talking scores in the high 600s at an absolute minimum, and more often in the 700s.
So if you're rocking a 580 credit score because you missed some phone bill payments 3 years ago, this door is likely locked for you.
Tightly locked and bolted. They're also going to look at your income, your other debts, your whole financial picture.
And even if you have the credit score, you have to pass the math test, the ratios, specifically the LTV. Loan to value. This seems to be the holy grail metric for lenders.
This is the metric that keeps bankers up at night. LTV is simply a fraction, the amount of loan debt divided by the appraisal value of the home.
Okay, help me visualize this. I want to make sure I get the math right. Let's say my house is worth exactly $100,000, just to keep it simple.
Okay, a $100,000 house.
And I still owe $80,000 on my first mortgage.
So your current LTV is 80%. You have $20,000 or 20% in equity.
Now, if I want a home equity loan on top of that, you said lenders look at the combined loan to value, or CLTV.
Exactly. They add the existing mortgage and the new loan together. So if you want to borrow $10,000,
my total debt would be $80,000 plus the new $10,000, so $90,000.
correct. Your new CLTV would be 90%. $90,000 divided by $100,000.
And there's a cap on that, right? They won't let you go up to 100%. They won't let me borrow the full remaining $20,000 in my equity.
Very rarely. In fact, most lenders want a buffer. They might cap you at 85% or 90% CLTV, depending on the market and your credit score.
Why? Why leave that money on the table?
Because they're terrified of the housing market dipping. They want to ensure that if the housing market drops by 5% or 10%, you don't instantly flip underwater.
Underwater, meaning I owe more than the house is worth.
The nightmare scenario. They want you to keep some skin in the game. They need you to have a financial incentive to keep paying the mortgage, even if values fall.
That phrase, skin in the game, is interesting because for the homeowner, that skin is actual cash equity. It's their savings.
It is. It's the portion they stand to lose.
So we know the mechanics, we know the gatekeepers. Now let's talk about the why. Why are people jumping through all these hoops? What are they doing with this cash? It's not just for fun, right?
Well, sometimes it is, but the data on this is really a mirror of American anxiety and ambition, to be honest. It tells a story about what we value and what we fear.
How so? What's the number one reason?
The top use cited in the source material is home repairs, home improvement projects.
That makes sense. That's the logical one. You borrow against the house to fix the house, new roof, new kitchen, finishing the basement.
It feels like a closed loop, right?
Yeah.
You pull equity out, you put it back in via a renovation, hopefully increasing the value of the asset itself.
Right, you're reinvesting in the asset. It feels productive.
Ideally, yes. If you spend $30,000 on a kitchen and the appraisal says it added $30,000 to the home value, it's a wash. You just converted illiquid equity into granite countertops and new appliances.
But then look at the other two common uses. They're a bit heavier. The second one is medical bills.
Oof, yeah.
That's the dark side of the piggy bank analogy.
It really is. It's people using their shelter as a safety net for a health crisis. It's emergency liquidity because they don't have the cash on hand to cover a surgery or a long-term treatment.
So the home becomes the lender of last resort for their health.
It often is. And the third big one, college education.
Ah, the other massive American expense. So investing in human capital.
Exactly. You see parents stripping equity out of their retirement asset, the home, to pay for a degree for their kids, making a bet that the degree will generate enough income to pay the loan back over time.
It's incredible when you think about it. It shows you how central the home is to the entire financial life cycle of a family.
It truly is. It funds the house itself, it protects the health of the family inside, and it funds the future earnings of the children. It's doing a lot of heavy lifting.
Now, I want to clear up a misconception I saw in the notes. I think this confuses a lot of first-time buyers. Some people think they can use a home equity loan to actually buy a house.
Yeah, that comes up a lot.
You hear loan and home and you put them together. Can you use one instead of a regular mortgage?
But I'm glad you brought that up because it trips people up constantly. By definition, a home equity loan requires equity. You have to already own the asset to borrow against it.
It's right there in the name.
It is. You cannot use a home equity loan to purchase a home initially because you don't own it yet. You have zero equity in a house you haven't bought.
It's like trying to withdraw money from a savings account you haven't opened.
Perfect analogy. You use a traditional mortgage to acquire the property. You use a home equity loan to refinance, cash out, or leverage the value after you've bought it and paid it down for a while.
And what about the timeline? A mortgage is usually a 30-year marathon. You sign the papers and you assume you'll be paying it until you have gray hair. Are home equity loans the same kind of long-term commitment?
Not always. While a first mortgage is almost always 15 or 30 years, home equity loans can be much shorter. Think of it as more of a sprint.
How short?
You might see terms for 5, 10, or 15 years. They're designed to be paid off faster.
Which sounds good, right?
Yeah.
Getting out of debt faster is the goal.
It is, but there's a trade-off. A shorter term means the monthly payments can be aggressively high compared to a 30-year amortization. You're squeezing the same amount of principal repayment into a much smaller window.
So your monthly cash flow takes a much bigger hit.
A significantly bigger hit.
Okay. So we've established the what and the why. Now we have to talk about the how, because it turns out when you walk into the bank, there isn't just one flavor of home equity loan on the menu. There's a fork in the road.
The great divide. This is where people often get paralyzed by choice. We have the closed-end loan versus the open-end loan.
Let's start with flavor number one, the closed-end loan. The source calls this the traditional approach. This is the vanilla ice cream of lending, I guess.
It's a great way to put it. When you sit at the dinner table and say, I'm getting a home equity loan, this is usually what you mean.
So what's the mechanism?
It's a one-time event. You apply for a specific amount, you get approved, you sign the papers, and wham, a lump sum of cash hits your bank account.
So if I need $50,000 for a contractor to build a deck, I get the full $50,000 on day one.
The full 50 grand. And because it's a lump sum, the structure is very rigid and predictable. You usually have a fixed interest rate and a fixed monthly payment for the entire life of the loan.
Predictable. I like predictable.
Most people do. You know exactly what check you have to write every month for the next 10 or 15 years. There are no surprises.
It sounds a lot like a car loan or a standard personal loan. Same structure.
Very similar structure-wise. It's safe, it's boring, and it's predictable. You get the money, you spend the money, you pay it back on a set schedule. It's great for a big one-time expense where you know the exact cost up front.
But life isn't always predictable, is it?
That's the catch.
Maybe you don't need all the money today. Maybe you need some now, some in 6 months. Maybe the contractor says the deck is $50,000, but then lumber prices drop and it's only $40,000. Now I have $10,000 sitting around that I'm paying interest on for no reason.
And that is the perfect entry point for flavor number 2, the open-end loan. Or, as the cool kids in banking call it, the HELOC.
Home equity line of credit.
That's the one.
This feels less like a loan and more like a credit card with a massive limit that's secured by my house.
That is the best way to think about it. It's a revolving line of credit. It's a revolving door. The bank approves you for a maximum credit limit, say $100,000. But on day one, you owe zero.
You haven't taken anything yet.
Nothing. You simply possess a checkbook or a debit card tied to your house's equity. You choose when to pull the money out, how much to pull out, and what to use it for, up to your limit.
The flexibility there sounds amazing. If I'm doing a home renovation and I don't know if materials will cost $20,000 or $40,000, I can just pay the bills as they come.
It's incredibly convenient for projects with uncertain costs or for having an emergency fund on standby.
And you only pay interest on what you actually borrow.
Exactly. If you have a $100,000 line, but you've only used $10,000 to fix the roof, you only pay interest on that $10,000. The other $90,000 is just sitting there waiting, costing you nothing in interest.
Okay, that sounds fantastic.
Yeah.
So where's the trap? Because that sounds too good to be true compared to the rigid lump sum loan.
The trap, or at least the major risk, is the interest rate. Unlike the boring, safe, closed-end loan with its fixed rate that never changes, HELOCs almost always have adjustable interest rates.
Variable rates. My stomach tightens just hearing that phrase.
It should. It means your interest rate can go up or down over time. The rate is typically pegged to a financial index, most commonly the prime rate, plus a margin set by the bank.
So the bank says, we will charge you the prime rate plus, say, 1%.
Correct. So if the prime rate is 5%, your rate is 6%. But if the Federal Reserve raises interest rates to combat inflation, or the economy heats up, the prime rate could jump to 7%.
And suddenly, my HELOC rate jumps to 8% without me doing anything.
Your monthly interest payment just went up significantly, and you have zero control over that external factor. You are floating on the waves of the global economy.
So you're betting that interest rates will stay low, or at least manageable for the life of the loan. That's a huge gamble.
You absolutely are. And there is another seduction here that catches a lot of people off guard. It's the payment structure during the initial phase.
What do you mean?
Most HELOCs have two phases. The first, often for the first 10 years, is called the draw period. During this time, you can borrow from the line, and the source notes, your minimum required payment can be interest only.
Wait, explain that. I can pay the bill every month, but not actually reduce the principal debt I owe.
That's exactly it. If you've borrowed $50,000, your minimum monthly payment is just the interest that accrued that month. You aren't paying back a single penny of the $50,000 itself.
So you're just renting the money from the bank.
You're just renting it. And because it's interest only, the monthly payment is tiny. It feels very, very affordable. It makes it easy to borrow more and more.
That sounds like a ticking time bomb.
It is, because eventually the draw period ends, usually after 10 years. The line of credit freezes, you can't borrow anymore, and the loan converts to the repayment period.
And what happens then?
Suddenly you have to start paying back the principal and the interest, usually over the remaining 15 or 20 years. Your monthly payment can double, triple, or even quadruple overnight. We call it payment shock.
Payment shock. I can see why.
And if you aren't financially prepared for that massive jump, it can be devastating. It's one of the biggest risks of a HELOC.
That's a nasty surprise waiting for you a decade down the road.
Wow.
So you have the certainty and predictability of the lump sum versus the flexibility and serious risk of the HELOC.
That's the fundamental choice.
But regardless of which one you pick, we need to talk about the elephant in the room, the government, and specifically the tax man.
Yes. The 2018 tax reform bombshell.
Bombshell feels appropriate because growing up and even just watching TV commercials 5 or 6 years ago, I always heard that the smartest thing about home equity loans was the tax deduction.
It was the #1 selling point.
It's practically free money. The government helps pay the interest. That was the vibe.
That was the conventional wisdom for decades. The sales pitch was, don't use a credit card, use your house, it's cheaper, and the interest is tax deductible.
Prior to December 31st, 2017 in the U.S., you could deduct the interest on up to $100,000 of home equity debt.
And it didn't matter what you spent the money on. For the most part, no. You could use it to consolidate credit card debt, buy a boat, take a world cruise, and you could write off the interest on your taxes. It was a massive government subsidy for this type of borrowing.
It effectively made the loan cheaper because you got a chunk of it back at tax time. It felt like the government was sponsoring your new deck.
They essentially were. But then came the Tax Cuts and Jobs Act of 2017, signed into law in December of that year.
And the rules changed
Drastically.
Huh.
As of 2018, the broad deduction for what they called home equity indebtedness was suspended. It's gone through at least 2025, and maybe for good.
Gone, just like that.
For many people, yes.
Yeah.
Now, we have to be very precise here because there's a lot of confusion. The interest is no longer deductible just because it's a home equity loan.
But there's an exception, right?
There is a very specific, narrow exception. The interest may still be deductible if the loan proceeds are used strictly to buy, build, or substantially improve the home that is securing the loan.
So if I use the money for that new kitchen or to add a new bedroom, I might still be able to deduct the interest.
You might, yes. But the days of use the money for a boat and write off the interest are dead. If you use the money to pay off credit card debt, no deduction. Use it for college tuition, no deduction. Medical bills, no deduction.
That fundamentally changes the math on this, doesn't it?
Completely. It changes the entire calculation. You have to look at the interest rate naked, without the rose-colored glasses of a tax break.
It removes the subsidy. It puts home equity loans on a level playing field with other types of debt, forcing you to ask, is this actually a good deal, or am I just doing it because it feels easy?
Exactly, because the government isn't helping you carry the load anymore.
And to determine if it's a good deal, you have to look at the total price tag. And I don't just mean the interest rate, I mean the fees.
Yeah.
The source material had a laundry list of costs that made my head spin. It felt like death by 1,000 fees.
We call it the price of admission. And it can be steep. People often forget this part when they're seduced by a low advertised interest rate. They don't calculate the total cost of borrowing.
Okay, let's run through the laundry list of pain, as I'm now calling it. First up, a fee for something we already talked about. Appraisal fees.
Right. You have to pay the appraiser. Banks will pass that cost directly on to you. You're looking at usually $300 to $500, sometimes more in high-cost areas, just to find out if you even qualify for the loan.
And here's the kicker I saw in the notes. You usually pay this even if the loan gets denied.
That's the painful part. You are paying for the service of the valuation, not for the loan itself. So if the appraisal comes in too low and the deal falls apart, you're still at that cash.
Ouch. Okay, what's next? Originator fees.
That's basically the bank charging you for the privilege of processing your paperwork. The ticket processing fee of the banking world. It covers their administrative costs and their profit.
It can be a percentage of the loan amount, right?
Often, yes. 1 or 2% of the loan amount is not uncommon. On a $50,000 loan, that's another $500 or $1,000 right there.
Then there are title fees and stamp duties. This sounds like government stuff.
It is. These are costs for checking the property's title to make sure you actually own it and there aren't other secret liens on it. And then there are state and local taxes, or stamp duties, for recording the new lien. It's all administrative friction, but it costs real money.
Now here is one that feels particularly mean-spirited. The early payoff fee, or prepayment penalty.
Yes. This one always angers responsible borrowers who are trying to do the right thing.
Explain the logic. It seems crazy. I borrow money, I get a big bonus at work, or I just scrimp and save, and I want to pay the loan back early to get out of debt, and the bank fines me for it.
They do in some cases.
Yeah.
You have to understand the bank's business model. They don't lend you money out of the goodness of their hearts. They lend it to earn a predictable stream of interest payments over time.
They've planned on that income.
They've projected that income. If you pay the loan back in 6 months instead of 10 years, they lose all that future profit they were counting on. The fee is there to recoup some of their lost revenue.
It's like a trap. Here's the money, but don't you dare give it back too fast.
It really emphasizes the need to read every single line of the fine print before you sign. You have to ask the loan officer directly, is there a prepayment penalty on this loan?
And there was another fee that seemed just as frustrating, but for the opposite reason. This one is specific to the HELOC, the inactivity fee.
Oh, yes.
This is a fee for doing nothing, for being responsible and not borrowing money.
Pretty much. If you open a $50,000 line of credit just in case of an emergency, which many financial advisors tell you is a smart move, but you never actually use it, some lenders will charge you an annual fee of $50 or $100 just for keeping the line open.
So you pay to borrow, and you can also pay not to borrow.
In some cases, yes. The bank's argument is that they have to reserve that capital for you. They have to keep it available on their books in case you ask for it. It costs them money to keep that facility open.
So they want you to use it.
They want you to use it, so they penalize you if you don't.
It's also counterintuitive. Now, amidst all these fees, there was one pro tip in the source material, something about surveyor costs. It seemed like a rare opportunity to save a buck.
Yes, this is a rare nugget of good news. The source notes that some of the valuation costs, like paying for a property surveyor or the appraiser, can sometimes be reduced.
How? By asking nicely. By pleading.
By doing some of the legwork yourself. The tip is that if the borrower finds their own licensed surveyor to inspect the property, rather than relying solely on the lender's default, an often more expensive vendor, they can sometimes shave a bit off the closing costs.
That is actionable. It requires making a few phone calls and getting some quotes, but if it saves you a few $100, that's absolutely worth it.
Absolutely. But even if you save a little on fees, we have to circle back to the biggest cost of all, the one that doesn't show up on the fee sheet, the risk.
Right. Section 6 in our outline, the bigger picture.
We've danced around this, but we need to stare it in the face. The source links to an article titled, "Putting Your Home on the Loan Line is a Risky Business."
Subtlety is not their strong suit, but they are right.
They are.
We talked about the lien, we talked about the collateral, but practically speaking, what is the nightmare scenario? What happens if you lose your job and can't make the payments for a few months?
The nightmare scenario is foreclosure. It's that simple.
So it's not like a credit card.
Is nothing like a credit card. If you stop paying your credit card, you get harassing phone calls, your credit score tanks, and maybe eventually they sue you and try to garnish your wages. But you still sleep in your bed. You still have your home.
But with a home equity loan.
If you stop paying your home equity loan, the lender can initiate foreclosure proceedings. They can legally seize your home and sell it at auction to get their money back.
You are betting your shelter. You are wagering the place where your kids sleep against your ability to pay back the loan.
That is the raw truth of it. And there's another, more insidious risk related to the broader economy. Negative equity.
This is the underwater concept we touched on earlier?
Right. Remember that CLTV ratio? Let's say you borrow right up to the max, maybe 90% of your home's value. You have very little equity left, only 10%. Then a recession hits. The housing market in your area drops by 15%.
Uh-oh.
Suddenly, the house is worth less than the combined total of the loans attached to it.
You are underwater. You owe, say, $300,000 on a house that is now only worth $280,000.
Exactly. And the consequence of that is you are trapped. You literally cannot sell the house unless you bring a check for $20,000 to the closing table to pay off the difference to the banks.
It locks you in place. You can't move for a new job. You can't downsize if you want to retire. You can't escape the debt. You're just stuck.
It completely reduces your flexibility in life. It's a powerful tool. It can fund dreams and fix major problems, but it binds you to the property and the market conditions in a very tight and sometimes suffocating way.
This has been, well, it's been sobering. It's a lot to think about. Let's try to pull all these threads together. We've covered a massive amount of ground today.
We really have. From the basics of liens and appraisals.
All the way to the risks of payment shock and foreclosure. I think the biggest takeaway for me is the choice, the fork in the road.
Yes. We've distinguished the tools.
Yeah.
The predictable, fixed-rate, closed-end lump sum for that one big expense.
Versus the flexible but volatile adjustable rate HELOC for ongoing or uncertain costs.
And we've learned that the government isn't helping us out anymore for the most part. Since the 2018 tax reform, that sweet interest deduction subsidy is generally history for most use cases.
Which means the math has to stand on its own.
It does. And we've seen the price tag. From appraisal fees to originator fees, from prepayment penalties to inactivity fees, this is an expensive game to play.
And the entry requirements, good to excellent credit, a solid income, and sufficient equity, mean it's a game only certain people can even join.
And ultimately the stakes, the non-negotiable risk of foreclosure, the economic risk of going underwater if the market turns.
It's not just a piggy bank. It's a high-stakes financial contract with your shelter as the bargaining chip.
Well said.
So here is the final thought I want to leave you, the listener, with. We've spent decades in this country thinking of the home equity loan as a standard part of the American financial toolkit. It's how our parents fixed the roof. It's how they paid for college. For a long time, it was a no-brainer.
But the world has changed. The rules of the game are different.
Exactly. With that tax deduction gone, with interest rates being much more volatile than they were for the last decade, and with all the fees piling up, does the home equity loan still deserve that same place on the pedestal?
It's a serious question.
Or has it become just another, frankly expensive way to borrow money, one that carries the unique and terrifying risk of leaving you homeless if life throws you a curveball?
It's a calculation every single homeowner has to do for themselves, based on their own finances and their own tolerance for risk. But at least now, you know all the variables you need to solve that equation.
Knowledge is the best equity you can have. Thanks for taking this deep dive with us.
Safe borrowing, everyone.